insights that we've had. Isn't it true to form that whenever you hear from an elder, there's many nuggets for you to actually absorb and fully unpack within the environment? I do see the room is emptying out. We certainly were not chasing you away. If anything, we want you to stay in the room because there's lots more conversation that will be shared in invigorating themes and conversations that we'll be alerted to today. I'd just like to gauge, how are we feeling? Eish, I'm hearing eish. That's a South African expression for it can mean anything. How are we feeling on this end of the room? We good? I'm expecting inspired, challenged. Okay, inspired. On this end? Inspired? So, we're going to go with the group think. I'm sure you're going to use a different word. Compassionate. You are coping. I love that. Yes, you are coping. But why I say this is because I think as we have been going through much of the day, we have certainly been absorbing a lot of information and, of course, garnering some of the key themes that we need to hold on to. And most importantly, we do want to remind you that much of the information, the resources, the conversations, access to your peers and colleagues who have been on the stage will be afforded to you throughout the course of this conference and even afterwards in resources and information that will be shared to you. But most importantly, we hope that what we are doing is bolstering your inertia to ensure that as we leave here over the next 2 days, we will be able to implement much of the solutions that we've been hearing about, including the reflections that have been shared by His Excellency, Mr. Ban Ki-moon. Get into action. Raise your voice. Make sure that we provide the necessary infrastructure to upskill future generations and ensure that our societies are able to thrive. One of the key themes that His Excellency mentioned as well was investment in infrastructure, energy. And that takes us straight to our next conversation, a 35-minute panel discussion, which will be moderated with some insight. And once again, you're more than welcome to participate by asking your questions through the moderator to various participants. This is where we're going to peel back on a key theme that we know is one of the key propellers to unlocking the opportunities we need on the continent. This particular panel discussion will focus on investing in infrastructure and energy finance, and moderating this particular conversation will be Mr. Adil Kaji. He's the head of energy and infrastructure finance for investment banking at CIB under the Standard Bank Group. He'll be joined by several panelists who'll be joining us on stage and addressing many of the questions and themes that will be discussed in conversation today. He'll be joined by several speakers, and one of whom is Mr. Wola Asase, the Deputy Director, Head of Syndications at the AFC, the Africa Finance Corporation, followed by Mr. Jonathan First, Senior Consultant at MIGA, Multilateral Guarantee Agency member of the World Bank, Her Excellency Lerato Dorothy Mataboge, Commissioner of Infrastructure and Energy at the African Union, Mr. Dirk van den Berg, Head of UK Export Finance for Southern Africa at the UKEF. If we can please warmly welcome to the front of the stage our moderator, Adil Kaji, who will guide us in terms of the conversation, as well as guests and panelists who will be joining us for this discussion.
Clear that considerably.
Jonathan, we thought we lost you for a moment.
I didn't have any power.
I'm conscious of two things. One is that we do have the graveyard shift. And the second is after Sim and Ban Ki-moon, that is quite a tough act to follow. George, can I just make sure that you are online?
Very well. It's a pleasure to join the panel online.
There we go. Thank you.
Can you hear me?
Yes, we've got you. Thank you, George.
All right, thanks. Great.
I think one of the things that you would have got very clear through all of the conversations since this morning is that Africa's infrastructure challenge is no longer just defined by a lack of capital, but really by the mechanisms required to mobilize it at scale. And so we've heard it time and time again. We've heard about the 150, 180, $200 billion per annum infrastructure financing gap that exists on the continent. But at the same time, there is $1.5 trillion worth of domestic capital that exists on the continent. And what we want to explore in this session is really how we mobilize that capital at scale. How do we shift the focus from flows onto the continent to flows that are to capital that exists on the continent and mobilizing it at scale? This panel will focus on some practical levers, so how pension funds, development banks, and commercial lenders can work together to de-risk projects, to lengthen financing tenors, and move from isolated assets to pipelines that are scalable and aligned to trade corridors and industrial clusters. The objective is to leave with clear views on which instruments work, what regulatory changes matter most, and what should happen next. Before we get going into questions, I'd like to frame the conversation just with 5 statements that we want to focus on. The first is that domestic institutions are cornerstone capital on the continent. How are we going to mobilize it at scale? The second, banks' roles are evolving from hold to maturity lenders to arrangers, distributors, and recyclers of capital. The third, blended finance, something that we would have heard more and more often, is a mobilizer, not a replacer. Credit enhancement and first loss guarantees exist to crowd in more domestic capital. The fourth, regional integration and cross-border infrastructure. Scale is really only going to come from pipelines, not single assets. Corridors and industrial clusters matter. And the last is always going to be around regulation. Regulation shapes flows. Fiduciary rules, capital treatment, and FX frameworks will determine outcomes. That's going to be the framing. We'll go straight into questions with my respected panelist. Jonathan, I'm going to start with you. I know that this is a topic that you are quite passionate about, and we were speaking about it the other day where we used the term unlocking domestic financial ecosystems. Could you give us an idea of how MIGA is thinking about domestic capital and domestic financial ecosystems?
Thanks very much, and thank you, Standard Bank, for inviting me to speak. So I think the whole funding dynamic has changed. We speak about inbound and outbound funding. South Africa was always regarded as an inbound country. In other words, the international banks, predominantly the banks in Europe, UK, and America, were funding projects in South Africa. This whole dynamic has changed. We see now South Africa as probably the most prominent and effective outbound market into Africa. So I did a quick analysis, and if you look at the top 10 banks in Africa, positions 1, 3, 5, 6, and 7 are filled by the South African banks. Standard Bank alone has 21 operations in Africa. You consider, if you exclude North Africa, there's 48 countries. They're in almost half of the countries in Africa. Similarly, ABSA has a very big footprint, and so does the other Southern African banks. So we've realized that the funding into Africa is not going to come from where we believed it used to be, or where it used to be. It's now going to come much more from South Africa. Also, if we talk about the asset managers, the 3 largest asset managers are all based in South Africa. But not just by assets invested, in terms of actual investment in Africa. So one of them, for example, 91, has 3 dedicated African funds. We know that AIM has a very significant Africa fund, as does Sanlam. Sanlam is the largest insurer on the continent. So we've changed our whole thinking, and we're far more focused now on the financial institutions present in South Africa and how we can support them with funding projects on the African continent. This also extends to the DFIs. And once again, I'll use South Africa as an example. I'm a bit biased, but the DBSA has a footprint of 18 countries in Africa, sub-Saharan Africa, and the IDC is present in 11. So there's a lot we can do from South Africa to support infrastructure investment in the rest of the continent. Thanks very much.
Thanks, Jonathan. I think the one other piece that I'd like to explore is just how roles are shifting. And so, Wole, if I may pass this one on to you. I mean, the role you play is often centered around finding capital for African risk. How are the roles of DFIs evolving beyond balance sheet funding?
Yeah, sure. So I mean, I think, one of the things which is critical is the fact that, AFC, for example, was set up by African capital to invest in Africa. And we've done this successfully over the last 18 plus years. We've mobilized domestic capital significantly. We have today about 12% of our shareholding as pension funds from Africa. We've basically come to a place where we're looking at how do we sort of bring in this domestic capital through platforms. So one way we pride ourselves is the fact that AFC itself is a platform where we can bring in domestic capital into that platform. We're setting up other sort of platforms. So we have a renewables platform. Today, we have about 1.3 gigawatts of renewable assets, operational assets, and we have another pipeline of about close to 13 gigawatts of renewable assets. We're also creating an industrial zones platform through Arise IIP that we currently own. We started off in Gabon, and that has basically scaled up into about 12 African countries. We also have an asset management company today that we're basically raising a fund for, which is an infrastructure crisis resilient fund, which effectively is going to be co-funding with AFC into climate resilient projects and using a blended finance structure. And with that, we're able to crowd in pension funds. We're looking at a vehicle that allows for us to bring in local Nigerian pension funds into that vehicle to be able to make investments. The other way that we're also looking at it, we've, for example, invested in infra credit, using infra credit as a guarantee vehicle that allows for us to crowd in local pension funds to be able to match the assets for infrastructure investments. And we're trying to replicate that also with another company in Kenya called Damana. Now, obviously, trying to get and to mobilize at scale in Africa has not always been the easiest. And so the way that we are looking at this is obviously to create these platforms that allows for us to be able to mobilize at scale domestic capital into either the balance sheet or into the sort of platform vehicles that we're raising. We're also doing this across other forms of structures. And so, for example, not only are we doing that through fund structures or through the AFC platform and through other platform vehicles, but also through managed programs, for example, where we are basically going to pull together liquidity from a number of investors where they can co-invest alongside AFC, because then that gives some efficiencies and skill. And so instead of doing this on a single asset basis, you'll basically be able to pull the skill together to be able to get this done in an efficient manner. Other sort of structures that we're also looking at include SRTs, so synthetic risk transfers, because that's also a way to basically churn the balance sheet and bring in liquidity on a secondary basis. And we use that, and we're able to use guarantees, for example, use first loss structures to be able to create structures that allow for us to be able to offlay some of that risk to investors. So it's evolving from the traditional, syndicated loan format where you're just bringing in syndicate of banks, but going into more structured products that allow for us to effectively leverage the balance sheet, but also bring in investors at scale.
We talk about DFI starting to play a role as catalysts for more commercial bank funding, which then would swap into more institutional money. I mean, one of the other catalysts that I'd like to also talk about is really export credits on the continent, something that those of us who've been funders of the sector for many years know the importance and the role that ECAs play in the structuring of many of these transactions. Dirk, do you mind commenting on how that landscape is shifting? I mean, over the past, I would say, 24 to 36 months, it's been interesting to see the increase in volume and flow of export credit onto the continent. Maybe can we talk about the types of projects and the role we see ECAs playing as we develop infra projects on the continent?
Yeah, brilliant. Thank you, Adil. And again, thank you to Standard Bank for this opportunity too. And I must say, it's actually the first time that we're talking ECA funding today. A lot of other products have been mentioned, other players have been mentioned, but ECA hasn't been mentioned. And I've been waiting for this opportunity, to be quite honest with you. I think it's Export Credit Agency or ECA funding is something that's been around for a very long time. UKEF is the oldest ECA, it started in 1919. So there's a lot of experience in that. I think from an Africa point of view, we certainly see that as a major opportunity for us. I'm actually one of 6 on the continent, based in country itself. I'm based in Johannesburg. Then we've got Isaac that's actually here as well, based in Nairobi, looking after East Africa. I look after Southern Africa, Angola through to Mauritius. And then we've got 2 colleagues in West Africa and 1 in Egypt and 1 in Morocco. So very, very strong foothold and presence in Africa. I think it's one of those, it's 2 dynamics. Those countries that are doing ECA funding and those countries that are looking at doing ECA funding and that haven't done that, pull the trigger yet, so to speak. Where we have been very successful, and I'll focus on Southern Africa itself by way of example, we've been very successful in Angola, committed and out of the door around about £1.8 billion, and talking about infrastructure projects, it's any and every infrastructure project itself. We're currently busy with the Cabinda Airport. We've done several hospitals, and it's heartwarming to see the hospitals and the mortality risk and rate that's fallen to 0 in the mother and child hospital, etc. But then also transmission lines, roads, infrastructure. Cabinda in Benguela province, we've done 26 sub-projects, and it's wastewater management, where there were massive deaths on people drowning when there's floods, etc. So it's very varied. From a UKEF point of view, we can enter into any project other than fossil fuels. We don't do any fossil fuels, so LNG, coal, etc. is out for us. But what we do, obviously, as an export credit agency, you follow the UK supply chain. Because it is tight funding at the end of the day, our requirement is 20% as a minimum. Some countries where we full on cover, etc., it runs about 30 to 40%. But I think what we're seeing is the countries that are using it extensively, and the countries that aren't using it, my appeal there would be is speak to your neighbors, speak to the countries that are doing that, and from a banker's point of view, we're not in competition to the banks, as we all know here, or should know. We're complementary to the banking industry. We obviously credit enhance it, where we bring in the AA credit rating from the UK government. Other ECAs will bring in their government ratings, etc. We enhance it. Risk-weighted assets are reduced. We believe it should be 0, but it's not. But we should, that's a discussion for another day. We're very happy to go to the central bank in Southern Africa and go and present our cases with the banks. It's there, and then the big thing is we extend the tenor. We can go up to normal infrastructure 15 years plus construction period, renewables 22 years plus construction period. So there's a real incentive to look at these as alternative structures or funding structures and mechanisms. It's commercial funding, it's not grant funding or anything, but it's commercial funding at very attractive rate and longer tenors.
Thanks, Dirk. I mean, we've touched on a few of the mechanisms that can create velocity in pooling more and more domestic capital. I think the one theme that was also recurring through the conversations this morning is how important regional integration is and how important regulatory environments are. George, if I can shift over to you for a moment. I mean, we spoke about products that MEGA offer. We spoke about AFC and some of the platforms, and we spoke about ECAs. Obviously, none of this means anything unless we've got regulatory environments that are enabling. From your lens, could you comment on what you would see as the most urgent regulatory shifts that need to happen on the continent to drive more cross-border integration?
Thank you very much. Let me join to appreciate my fellow panelists and also for Standard Bank for convening this. I'm representing the Commissioner, Her Excellency Lerato Mataboge, Commissioner for Infrastructure and Energy in the African Union Commission. My name is George Aoko, PIDA Coordinator. I think I want to join my fellow panelists to say that two things. One, Africa is not short of resources in terms of finances, because the financial sector in Africa has really grown over the years. Number two is that Africa does not also lack projects, because we talk about the infrastructure gap, whether it is in terms of physical infrastructure and also in terms of the financing gap. And so within the continent, of course, from the African Union point of view, we have actually set an agenda, which of course I believe most of us by now are pretty aware of, the Agenda 2063, the Africa we want. And it clearly states in terms of integrating the continent and also making the continent prosperous through our internal resources, whether it's finances, the people and all that. And you look at the architecture of the continent in terms of delivery, we have the member states at the lower level. Then we have the regional economic communities, the RECs, which of course the 8 of them at the regional level. And then we have the African Union Commission at the continental level. And so from the top, in terms of the African Union Commission, we work with our regional economic communities to our member states to be able to identify what are some of the areas that require us to be able to use our convening power as the African Union Commission to support our member states in terms of delivery of key infrastructure projects. And so we work both in terms of identification of policy and regulatory frameworks, and also in terms of project identification, preparation, and implementation. And so in terms of the fragmentation of regional projects, we have worked on a mechanism where we are able to identify regional projects that actually can be viable in terms of the size, in terms of magnitude and size of the projects, but also working with our member states in terms of plugging in the regulatory issues. Of course, one of them, which I know has not been in the continent for a long time, but is gaining momentum, aspects to do with the PPP laws in terms of framework because when you talk about financing from the domestic financing institutions like banks and pension funds, insurance funds, and all that, it's a different model from the traditional financing of public financing, DFIs and MFIs, because these institutions are looking for investments for profitability. And so creating that environment where they'll be able to have an opportunity to see an avenue to be able to invest so that they can able to make returns, because they are not charity organizations. They are organizations that exist for purposes of making profit. And so creating that legal framework, we have a number of our countries that have advanced in that space, but we are creating an opportunity where those of our countries, member states that are lagging behind in terms of those legal and policy, legal and institutional frameworks, can actually benefit from peer engagements with other countries that have actually developed. And that is something that we are working within the infrastructure space as the Department of Infrastructure, so that we are able to attract more of this domestic financing to support and be able to plug in our infrastructure gap. So I think that is exactly what we are working on with our regional economic communities and also with our member states, to be able to create an environment where the domestic financing institution feel some level of comfort to be able to see that the environment is conducive and the projects are there, the pipeline of projects are there that they can actually seek to be involved in and finance, so that we can actually use that domestic financing that is there but has not been tapped.
Thanks. Thank you, George. Jonathan, I'd like to come back to you again. We speak about scale, and we speak about moving away from single projects to pipelines. And we often talk about the only unlock to that being a lot more programmatic in approach. Would you care to share some of your thoughts on how your institution is actively pursuing programmatic approaches to project delivery?
So there's two dynamics here. MIGA has recently innovated in terms of its what's called non-honoring product. So it's created something called a non-honoring credit substitution instrument. At this stage, it's at the sovereign level. And what they've done is they've created a structure which has a first and second loss. So to be able to be eligible for non-honoring as opposed to PRI, political risk insurance, you need to be BB minus and above rated. And this is a MIGA rating. This is not one of the sort of standard ratings. So a lot of countries, as you can imagine, in Africa are not BB minus. In fact, I think there's probably now 6, maybe 7 that are BB minus and above, maybe 6. So what we've done through this layering, this first loss and second loss, is we've effectively pierced that ceiling. And we're talking about going as low as B minus, which is 3 below BB minus. So you're now bringing in a lot more countries which become eligible for non-honoring. The first loss is going to be covered by the World Bank, by IBRD, through effectively normal indemnity-based support. And then the second loss will be MIGA. Now, you know, MIGA doesn't ask for indemnity from governments. So we cover 90% of loans without an indemnity agreement, as opposed to the IBRD, which requires indemnity. So I think that's one of the dynamics. We're now going to start taking that down to the sub-sovereign level. Because, you know, sovereign is obviously important, but we want to now start looking at the sub-sovereign. So in that context, there is a transmission facility or transmission program called ARTIF, which is a $1.4 billion facility, which is to support transmission infrastructure in the SAP, the South African Power Pool. Now, the issue you have in SAP is there are 12 members, but only 3 of those are BB minus and above. But what we're trying to do through this kind of structuring, and it has a slightly different structure to the first loss, second loss, in the sense that it has its own inherent first and second loss, is for us to be able to bring non-honoring at what we call the senior tranche to cover all 12 countries. So that's what we mean by a programmatic approach. We're bringing an opportunity to a far greater funding program, once again, to cover infrastructure.
And I mean, effectively what you start doing there is creating, one, a lot more eligible markets and automatically many more eligible projects that are going to attract capital. Dirk, again, I mean, when we think about export credit, particularly in its, in the sense we work with it every day, it's largely a product that we apply on a project-by-project basis. I'm wondering, you know, as we talk about platforms and we talk about scale, does the role for ECA start shifting? And if so, what does it look like?
Yeah, so good question. And again, you know, the mandates of the OECD ECAs are fairly limited and restricted. So, you know, from a UK point of view, again, we're trying to be as innovative and as out there as possible. Having said that, we're still very focused on project base at this point of time. And there's a couple of reasons for that. Obviously, you've got your ESG requirements, and depending on what the infrastructure project is, you've got to comply with that per product. We are looking at some on-lend type of structures. Now, we haven't done too many of those. I'll put it out there. I think we've done one in South America, if I'm not mistaken. But that is something that we could potentially look at and see how that goes. You know, on-lend to the bank, take a risk on the bank, and then they on-lend there, maybe on slightly more, but it is still project focused at this point of time. But, you know, other projects or products that we're trying to be innovative for is for your pre-feasibility funding structures, etc. And those are also something that one needs to try and look at. You know, through one of our projects, our products, EPSG, it's a loan, it's a 2-year loan after final drawdown, but it does allow the borrower to, you know, do his feasibility study and pre-feasibility studies there, etc. At this point of time, very much still project focus, and I think it will remain like that, but is there room for movement at the later stage? I think there is, and I think the ECAs are looking at ways of becoming more innovative from a product point of view. But at this stage, like I said, it's a fairly narrow mandate.
Thanks, Dirk. I mean, Wole, again, just on the topic of scale, you mentioned some of the platforms that the AFC has been involved in. I want to tie that into projects that you've been involved in that relate to cross-border or corridor financings, and what those structures look like that involve multiple geographies, large projects that span, port and rail and border crossing infrastructure. Are we seeing more and more of those type of financing start appearing on the continent?
Yes, I mean, we're actively involved in a number of them. I mean, I think one of the audience was asking a question about Lobito Corridor. I mean, this is one that we are actively leading as a lead developer, working with the US and the EU governments alongside AFDB. And so we are basically developing that project. We put in some development funding and working through that. Obviously, this is going to open up the corridor between Angola, DRC, Zambia. And obviously, this is cutting across multiple jurisdictions. And so that obviously means that there has to be a lot of collaboration across the countries and ensuring that all the countries are in alignment across that value chain. There's one line which is rehabilitation. We acted as a co-financial advisor for that. We raised about $750 million for that. Funding came from DFC, DBSA, and obviously now we're looking at the Greenfield project, which is going to open up that whole corridor, in terms of goods and services, but also more especially for the critical minerals routes along that and opening that border to the ports. We've also done a large-scale financing on the rail side from Kano, which is in the northern part of Nigeria, all the way to Niger. We raised about $1 billion last year for that rail infrastructure, which is currently ongoing. And then on the back of that, we're going to finance the rolling stock for that. But also that the ethos there is that it's going to open up that corridor between Niger and Nigeria. And then obviously there's going to be branch lines across that to create that integration across the regions.
Thanks, Wole. I see I've just been flagged to also move to Q&A. If I could maybe just compress what we've been talking about over the past 30 minutes. I'd say the first piece is institutional distribution is going to be absolutely critical for us to drive scale. The second is focusing on corridors and regional origination is going to enable more and more multi-country pipelines. And then programmatic approaches layered on with the right type of credit enhancement type products is going to mobilize more and more domestic capital. And the last is that, if I think specifically about commercial banks, is that the focus is going to evolve and shift more towards structuring platforms rather than originating and holding assets indefinitely. If I can park the discussion there for a moment and move to the floor for any questions for the last few minutes. That's how good you were, or the graveyard shift was really a graveyard shift?
Very good.
There seems to be a question in the back.
Hi, good afternoon. This is Vib Jain from the USDFC. So I have a question for Jonathan and for the other panelists that may have an opinion on this. Jonathan, you talked about how South Africa is responsible for a disproportionate amount of capital into Africa from a commercial bank perspective and the role of South African banks. And I was curious what the panel thinks is needed to drive even more capital from the South African private sector into Africa, given the magnitude of the financing gap. Thank you.
sorry, to understand the question, you say how to drive more capital from South Africa into Africa. It's going to go back to that old issue we always deal with, is investable projects. It's still the biggest, drawback or hindrance to, significant funding, infrastructure funding in Africa. There's not only money coming from South Africa, but money coming from anywhere. It's just you're not seeing. We've had a lot of conversations about how much money is actually sitting in domestic savings pools, in the banks, in the pension funds. It's not a shortage of funding. I suppose if you've got enough projects, you eventually run out of that. We've got a long way to go. I think that the biggest issue we still face is investable projects. And unfortunately, we call it the TA funding, grant funding, is just not at a scale in Africa that is sufficient to develop investable projects.
Yeah, Jonathan, that's right. I suppose it goes back to some of the fundamental challenges we deal with every day on the continent. It's one thing having all of the instruments, guarantees, etc., that we can use to mobilize more and more capital. It's another saying, well, actually, we've got well-capacitated government institutions and the right type of project preparation to deliver project pipelines to market. And so I think if we listen to President of the AfDB who spoke earlier, a big focus on from the AfDB is saying, well, how do we make sure we are creating more and more and better pipelines of projects through which then, all of these instruments start flowing into?
I just chip in, huh? Yeah.
Afternoon, my name is David. I'm from EDF Power Solutions. So it's an open question for the panel as a follow-on to your comment, Jonathan. So we've seen mixed success with project preparation facilities, and I'm speaking with the perspective of the South African market, and I'd be interested to hear how those have sort of fared in the rest of the continent. But from your experience, how can we sort of lever these project prep facilities to sort of bring these projects to a point where commercial capital can sort of come in? Because I think a lot of the times I speak to early stage developers, they try to get project prep facilities, but the requirements from the project prep facilities are sort of more commercial in nature. So there's a bit of a chicken and egg situation there. I want to get your sense on what the potential solve for that is. And from Wola's perspective, I'd be interested to hear how those sort of facilities have fared in the rest of the continent.
Yeah, okay.
Can I just respond?
Oh, okay, he wants to say something. Go ahead.
Yeah, let me begin by just talking around pipeline of bankable projects. I think it's quite interesting when we say we have a huge infrastructure gap, leave alone financing, the continent alone. If we start from the aspect of the trans-African highways, over 10,000 kilometers of road from the 1950s since they were proclaimed. That's a huge opportunity in terms of a project on the road sector. If we talk about the energy sector, we say that like half of the African population is not connected to energy. We have a huge opportunity in the energy sector. Leave alone now other aspects like, for example, digital, the fiber optic cable, the data centers and all that. So I think, and I like what the question that has just come about the chicken and egg, which one, because the projects within the continent are there. So that brings me to the second position around the project preparation, because I did mention that for the segment of the financing institutions we are looking at in terms of domestic financing institutions, banks, pension funds and others, they are coming from the point of profitability. And this brings me to the concern around the architecture around project financing. Under project financing, which of course, for us to be able to draw domestic financing for the huge amount of infrastructure projects that we have in the continent, because we need roads, we need rail, we need ports, we need airports, we need energy, we need data. There are 4 components that we need to really debunk under the project financing architecture. On one end, we have the project sponsors, who are basically the owners of the project. And for this scenario, we're looking at our countries, our governments, and all that, because most of the projects we're talking about are actually service projects, whether it's
Could I ask you to wrap up your comment in 30 seconds, please? We've run out of time.
All right. So basically, I'm saying that the issue of project preparation, for us to be able to have bankable projects, we need to address the issue of project preparation. Unfortunately, most of the institutions, our domestic institutions, are waiting towards the tail end when this process has gone. So what we are working on is having on board these institutions early into the project preparation process, and also if we can have what we call the seed capital for purposes of supporting the project preparation, so that it supports that pipeline of bankable projects to be able to then attract that financing that we need for projects. Thank you.
George, thank you. Jonathan Wale, I know there was a question from the audience. If I could ask you to maybe deal with that offline.
Okay,
ladies and gentlemen, thank you for listening. Panelists, thank you for joining me this afternoon. I'll hand it back to Gugulethu. Thank you very much.
Thank you.
Thank you very much to our panelists, as well as Mr. Kaji, moderating that conversation very precisely. And I guess it's because we are trying to ensure that we do our best to keep to time. But thank you to you all for your participation and feedback that you've given us in terms of the panel for today. We do have one more panel discussion and, of course, one more vision to get clarity on. We will be hearing some more insight little before we wrap up today's conversation. We'll hear from the likes of Ghana to give us some insight into the vision that they have set ahead for them in terms of growth, what that looks like in terms of monetary policy that's being aligned, and being mindful that the opportunities to engage in those discussions will still be available tomorrow. We must apologize. We were meant to host the vision of Uganda today. However, that will be postponed to tomorrow due to some unforeseen circumstances that came about. However, a representative will be present with us tomorrow to give us some insight into the vision of Uganda. We move and shift gears now. One more panel to help us see through the key aspects of the energy access as well as energy transition. Following this particular panel discussion, as mentioned, we'll hear on the vision of Ghana, and then we'll wrap up the program for today to make sure that we all are able to get amazing insight. I am cognizant of the fact that there's a lot more networking and engagement that many of you would like to participate in. However, we'll try to tighten up the program as best we can. Speaking of which, allow me to welcome the first panelists who will join us on stage together with the moderator, guiding us in a key theme focused on accelerating Africa's energy access and transition. It's not about the opportunity, but what is getting done. And I'm quite excited because the moderator made it very clear there are tangible examples and outcomes that we can speak to that are present now, talking about the ambition and how we mobilize it. Please help me warmly welcome to the front of the stage, and we're going to double check our energy levels, because if they feel alive, we all feel alive. Ms. Rensha van Tonder, Head of Power, Client Coverage at CIB Standard Bank Group. Mr. Christopher Clark, Managing Partner, Inspired Evolution Investment Management. Mr. Carl Corneliusson, Chief Executive Officer of NOA Group. Mr. Fred Thoring Flagstad, Director at Copenhagen Infrastructure Partners, and Mr. Wenzi Gondwe, Managing Director for Africa Green Co. Group Limited. Please give them all a warm round of applause, ladies and gentlemen. Thank you so much.
Thank you, everyone. Sorry, Adil, you didn't get the graveyard session. We got it. But I did promise that we will definitely spice up things. We're not going to talk about policies, challenges. We're going to talk about what we've achieved, where we are, and I'm really honored to have a panel today of 4 clients that we could say we walked the journey with. So for us, it's about energy access. It's about what can we achieve and how do we take it to the next level. I think when you talk about energy and power, it's been a long journey. Some of these things take time. It's not that simple, and you need to persevere, and you need to have partners. So we're going to split the conversation a bit in two. I got two investors, how capital is actually flowing into the sector, and then two clients where we really talk about innovation. How did we innovate not only in South Africa, but also in Zambia? So I want to start with Fred. Fred came all the way from Denmark. When I called him and asked him to join us today, he was eager to support us in this event. And specifically when you talk about CIP and what they've done on the continent. So CIP has invested in Molilo, one of our local project developers and IPP, and I think it was quoted that it was one of the most significant and biggest investments in the last 5 years in the private sector in South Africa. So I think, Fred, if I can turn to you, first of all, why South Africa, and what was your experience to date?
I think it's important to start by saying that outside of my office, I look over the pier of Copenhagen. There's about 10 centimeters of ice on the harbor right now. So when you asked if I would come and join you here, it's an easy answer. Weather is significantly better in South Africa. No, we started looking at SA in 2021, ultimately found an investment we're excited about in 22, and we're able to conclude that with ComCom approval in early 23. And I'm incredibly excited about what we've been able to do. The environment we looked at back then was fairly challenging. You had significant need for new generation capacity, load shedding on a daily basis. You had a hunger for new electrons coming onto the grid. So while challenging, we felt that we could actually make an impact on the ground. And through the investment we've been able to make in Molilo, we are currently on track to deploy 100 billion rand worth of investments in South Africa in solar, wind, and battery storage projects across more or less all nine provinces. And that has been a significant success for us, gone better than we had hoped. And I think this is in part due to the fantastically talented people we've been able to bring on board on our teams down here. So it was a challenge to get it through the investment committee. You get the inevitable questions of why Africa, why don't we go somewhere else, why is this important? We have a global scope. We don't have a specific mandate for Africa. But because of the core demand, because of the sort of indisputable need for the renewable energy, we got comfortable quite quickly that this would be a great destination for us to be, and we've not been sad. We're quite excited still.
Thanks, Fred. And we appreciate you coming to sunny South Africa, especially in Cape Town with the wonderful weather. I want to follow on that. I mean, your appetite for South Africa and your experience to date. I mean, what is if you put one burning question out there in terms of a concern going forward to deploy more capital? And I think you've mentioned your pipeline, and I think if many of you don't know, I think we've got 15 projects that is in the pipeline for the next 24 months to reach financial close, which is quite significant. So just the key thing that you will look out for to do more in South Africa.
So I think at its peak, we're likely to be constructing north of 20 projects at the same time. That's not easy, but we have really good partners, and that helps us a lot. What are key concerns for us in finding new investments? It's finding investments that fit our profile without conflicting with the current investments that we have. We need to find things that are minimum 2 billion in equity ticket rand. So that's a bit of a challenge for us. If I may say, there are a few macro things that are also teasing us a little bit. It's incredibly difficult for us to take some of our team members from our head office down to South Africa. So your visa rules are actually quite limiting and makes it difficult for us to actually have the proper stewardship over the investments that we would like to make down here in South Africa. I think that's a silly restriction to have. and one that I wish we would overcome, but nonetheless something that is a topic in our investment committee. A second challenge that we're faced with is your new property laws that allows for, in extreme cases, to take property without compensation. I can understand that there's a historic background to this, and I can understand that there might be a lot of rationale. But as a foreign investor coming in here, hearing that property can be taken without just compensation, it's a very scary thing for us. And while it may make sense in the context of the current government, one could fear that we would see a less judicious government in the future that might abuse those types of rules and laws. So that's a point of observation. And the last thing, if I were to mention something, it's a topic that we've heard many a times in South Africa. It's the construction mafia. This year we end up being in construction of 20 plus assets. Some of them in benign and very calm jurisdictions that are extremely friendly to us. But there are also some jurisdictions that, rightfully so, are very challenging. And it's not going to be helpful for further investments in the country if I have to explain to my investment committee that people with AK-47s rocked up to our sites and threatened our staff. So serious steps taken by government to address construction mafia is something that we actually would welcome and think would be a nice improvement onto how we deploy assets in this country.
Thanks, Fred. And just on that, maybe many of you may not know, but you know there's currently to the tune of 300 billion rand being invested in the sector in South Africa. And I think we don't see that scaling down soon. We still see a lot of momentum in terms of what we do, what's coming our end. And I want to just quickly shift to Africa. I mean, Chris, when we look outside of South Africa, sometimes we're being told, as a bank, you're not proactive enough, it's too difficult. I mean, we've closed last year 8 transactions and supported clients outside of South Africa, and it was far more difficult than being the go-to bank and doing things the way we do it in South Africa, because it's regulatory environment, there's still open access need to be adopted. But what we've seen is that capital providers are critical in terms of unlocking some of the opportunities and take a different view in terms of investment. You've been involved in many of these countries, looking at it from a fund perspective. How do you see that environment expanding? There was some mention earlier this morning through AfC referencing Safiri. I mean, that's things that you are involved. Maybe you can share some light on that as well.
Sure. So we have been at it since 2006, the early days, being a first mover on the continent. And we being Inspired Evolution, that's a company I'm the managing partner in Inspired Evolution, together with my partner Wayne out of London. And we've been on the continent with 5 offices since then, sort of slowly evolving our suite of evolution funds. Our first fund was $100 million starting in 2007, very nascent markets. In fact, at those days, there were no commercially operating reference projects with renewable energy. The markets have really shifted dramatically, particularly in the last 5 years. So it's about selecting those tier 1 countries where you have the right enabling conditions for a deal signature that's investment grade, and then slowly building from that. But it requires an enormous amount of rigor and determination. I mean, there's no substitute for grit. But we've seen a situation since the sort of early days where South Africa was the dominant market, where we invested most of our first fund assets, shift completely around to where 75% of our deal flow is now outside of South Africa and even the common monetary area. And that's just based on low carbon integrated energy policies of progressive governments, you know, as they've caught up. It's still challenging in many frontier countries, so a detailed country categorization is really key. But that's, you know, our part of our differentiation is to make and move those markets. And we've got a group of investors that have been very loyal since the get-go. And we've managed to make reasonably robust returns that have allowed us to grow our funds under management. So it's really about moving steadily into the new opportunity set, making sure that you have an enormous amount of rigor, and you pay particular attention to the investment grade.
And just as a follow-on, the previous panel discussed a lot about programmatic scale. I mean, how important is that in terms of your business model and how to address market caps?
Scale is very important, particularly when it comes to new initiatives like Project Zafiri, which we are one as it's a managed account. So this is the $1 billion energy access World Bank Mission 300 initiative that we are the fund manager for, and that's about to close imminently. First phase of $300 million, and then it's a permanent capital vehicle. So those sorts of initiatives are fundamental to get scale. I mean, it would be a travesty if we couldn't get beyond phase one. You know, it has a certain very ambitious target to try and connect 6 million within the first 5 years, but then make a significant difference to the 300 million Africans that don't have residential connections at this point in time. So the ability to scale is really driven by a complex set of how do you create a platform that can crowd in commercial investors using first loss or junior equity in combination with technical facilities that we also manage in a sidecar to make it all work. And that's really the kind of alchemy that's necessary. We've done it before, and I think increasingly blended finance structures like that are no longer just an innovation, but they're going to become the norm for how we de-risk an inflow of equity into the continent. So scale is critical, but the issue we've got is that a lot of the bankers and a lot of the funders are still sort of sitting on the sidelines, waiting for kind of what they're used to, like what they're familiar with. This is unfamiliar territory, but it's increasingly on a convergent path between the sort of strategic investment and moral imperatives. And that's because of a whole bunch of factors, including price changes and transaction readiness.
Good point. We'll get back to that and your challenge to the banks. I'm definitely keen to take it up. I want to move from capital a bit to innovation, and I want to just bring you back to what we see, what's happening currently in a market like South Africa, and also move then into a follow-on to a country like Zambia. But I want to start with South Africa. What we've seen here is a deliberate effort by our government to transform the power sector and open up markets, specifically around allowing third-party access, transformation of the sector in terms of allowing traders, aggregators, and how we actually support corporates in terms of energy access. And I think one of the ideas or one of the initiatives that we've seen a number of years ago was this emergence of traders and aggregators in a transformed environment with legislation changing. One of the successful companies that you may have seen over the media and a number of projects that we've closed with them is NOAA. And I got Carl here today to just start by sharing the NOAA story. I know when I give you the floor, you can probably carry on for the last 22 minutes that we have, but just in a nutshell, and where you are and what next. So thanks, Carl.
Thank you, Rensha, and thank you, Standard Bank, for the opportunity. And maybe just let me start with clarification. This NOAA should not be confused with the guest speaker of last night. This NOAA was derived for the ambition of a net zero Africa, and I've heard about long journeys. I think we have people that have been in the industry for many, many years. I think our story has actually been a bit of a sprint. So maybe just by framework, what is an aggregator or a trader? The business model that NOAA follows is what I would describe a vertically integrated utility or platform model. So on the one hand side of the platform, we are building assets, so solar farm, wind farms, battery farms, and then we put all the electrons in a pot, and then we distribute it to multiple off-takers on the other side. And in our world, the off-takers are private off-takers. So that's sort of the business model in a nutshell. I have heard a lot about pipeline developments today. I think as a trader, we tend to flip things around. So for us, the pipeline is we start with the customer in mind. So we try and identify energy users that are ready to go on an energy transitioning journey. As a NOAA team, we found those customers in more of the large energy consumers in the country, being the mines, the smelters, the data centers, the larger industrial sector. And by understanding their needs, we then manage to back engineer to try and figure out what type of energy assets will be required in order to produce the energy profiles that these customers need. And it has been a bit of a sprint. As Renshaw said, we have been very fortunate. Over the last 18 months, we have closed just short of 1,000 megawatts of projects, deployed or committed about $1.5 billion to the platform, and there's no end in terms of the demand that we are seeing in the market. So the next 12 months will probably most likely be an acceleration. And I think an acceleration for any entrepreneur that builds a business is exciting. I think some of the challenges that one runs into when businesses scale in general, but I think specifically when they scale fast, is that what you've done last year is no longer relevant this year, and what you are doing now is definitely not going to be relevant 2 years from now. So maybe to talk or to give one example of innovation, I always say to get utility type business models right, it's a little bit like a triangle that you have to continue to balance. So in our world, you have to have a customer, you have to have electron, and you have to have a dollar. If you don't have those three things in balance, you can't get the ecosystem to move. But if you get the first two of those in place, very quickly the dollars start adding up significantly. So in our journey over the last 3 years, we had to recreate our capital structure 4 times. Very first business model, we said, we're going to build with equity. It's much easier to build and refinance later. Until the first time that you rock up to an investment committee with a 200 megawatt facility and people say, no, go back to the drawing board. Project finance is the way to go. So it was project finance, and with the support of Standard Bank, figured out a way to get an aggregator and a trader model bankable in the South African environment. In order to get an entity that doesn't exist suddenly bankable in a project finance world required significant guarantees that we with equity had to fund initially, and again we ran out of capital. So with the support of Standard Bank, developed a guarantee facility to allow equity to scale faster. And I think where we are today, project finance is working well, but I think that we are beginning to see a world where project finance is probably not going to be the vehicles that is going to take this type of business model through the next 5 years. So we're beginning to ask the questions around what does capital scaling look like in a world where the traditional models is probably going to run into its limits.
Yeah, I think that comes back to the challenge to the bank. How can we add that value? How can we step up and differentiate ourselves? I think the value proposition is along different products. I mean, for us to be able to be relevant and leading that at all times. I think I want to move to Zambia. Now, 3 years ago, I took our credit team with me to Zambia, and I said, we need to be bold here. We need to be able to step out of our comfort zone, because this is important for us as a bank to step up. And the real reason is not only the minerals and the opportunities around Zambia, but actually the linkages into its neighbors, and specifically DRC. Greenco has been a client of ours, and we've been in discussion for many years around the model, what can work and can't work. And I think because of the emergency situation in Zambia, we had the opportunity to really brainstorm with Greenco. And I think, Wesi, you've been at the heart of it in Zambia, dealing with some of these complexities and challenges. And I think maybe, not only to go through the Greenco story, but also the business proposition and how you work with your partners, being your clients like mining companies to solution for them.
Well, thanks, Rensha. And as you rightly say, as you look at a market, especially an African bank, a Pan-African bank, you need to look at the entire value chain, of the economies that you're supporting and the individual enterprises and businesses there. And when you support mining in Zambia, you need to make sure that you've got a robust service delivery to those mines, and you de-risk their operations. Greenco has been a journey, I think, of almost 8 years now, if not longer. And when we started out as a trader and aggregator in the market, long before you had any idea of where your first transaction is going to come from, what it's going to look like, you're on a journey really of engaging your national stakeholders, your utility, your regulator, to buy into what you see as a changing industry landscape, and really coming from a background where you had your default single buyer model in a lot of these markets that had served its purpose for a while, but that model had reached its ceiling and could no longer deliver what the market was demanding. And so we came in with on the premise of reallocating risk in the electricity market purely among private players, and we see the SAP market as the de-risking market, or the de-risking vehicle for projects to bring on new generation in the region. That's how Greenco's model is set up, is to really look at that regional market. It's a huge opportunity, and there's huge potential to drive the markets forward. And this is our philosophy. This is our belief. And so, indeed, coming to transactions that we did. I mean, we did our first transaction towards the end of 2024, with a crisis that happened. I think the worst crisis from a Zambian perspective in living memory, and our hydro generation all of a sudden was crippled. I think we had just done 750 megawatts at Kafue Gorge Lower. I think everyone thought, this is really what we need. But there we were with 80-90% of our generation exposed to hydrology and hydro risk. So on came the drought, and we were generating 30%, 40% of what our installed capacity was. And really, what we saw then was quickly as a trader and aggregator, we needed to have not just trading innovation, but also the financial engineering, innovation. And I think having a partner like Standard, who had understood the Greenco story from before, was not learning it then, because you took the interest, you took the time to learn it, and understanding what the SAP market represented, meant that we could go from inception to structuring what effectively was akin to a commodity finance or trade finance type structure, but I think with very interesting nuances. We went from initial engagement to closing out a transaction with special purpose vehicles built in there to facilitate it within 3 months, and close a $55 billion transaction, literally from cold start to finish, to import power from the region. But also importantly was not just importation of power, but it integrated the national utilities ESCO in such a way that we catered not just to supply to new customers when we started building out our portfolio, but to a structure that also provided a runway for the utility to have some breathing space to recover. And so you took a position on the ability of the utility to perform its obligations under the structure, utilizing the precious little hydro that we had to make the supply work over a 24-month period. And B, because our commitments under that structure to deliver power to customers involved significant exposure to the markets, i.e. trading on the competitive markets for complementary power that we had committed. You also took a position on that. And I think the future of financing transactions in the region, whether that's on the SAP or you move to the SAWEM coming in South Africa, is going to be market-based. And I think the financial institutions that quickly, shift their kind of like approach, traditional approach, to a market-based approach, I think are going to, lead the pack in terms of capitalizing on the opportunities that are coming. We did a second transaction last year on a 100 megawatt project, one of the largest projects outside South Africa. And again, there first a turnaround, and I think the belief also then in the underlying, off-takers that underpin the transaction. But again, it's also great from the perspective that the ability to take a solar profile and deliver a 24-hour baseload profile is underpinned by structures that integrate the utility, into that transaction. But finally, it also then foreshadows and introduces structures that already give a practical working example of what a full-on open access regime and framework would look like. You're talking about core supply, you're talking about generation profile transformation, etc., etc. So these are all very great, and I think begin to make for an easier transition because you've got working, practical executions of projects that deliver what a wider transformed sector is going to look like.
Wesley, I'll come back to you. I've got 9 minutes left and I'm cautious of time. I've got so many more questions. I just want to, Fred, back to Molilo business model growth, what we just discussed. The importance of continued growth with regard to transmission limitations. Just how important is that in growing a business with a pipeline that you're developing and finding solutions around not only the TDP, but ensuring that the ITPs are rolled out the way we see that? Just some thoughts around that.
It's obviously incredibly important for South Africa as a country that we keep seeing generation coming online for many years to come. A lot of power will be needed. A lot of power is predicted to be needed. And the transmission lines are getting increasingly constrained. And I would expect most grid capacity will run out in the next 1 or 2 years. So this is of paramount importance. Now, let's take it from my own little self-interest perspective. I'm investing in Molilo with the perspective of fixing the team, growing the business, growing the assets under management, and then ultimately selling that business. I am selling a growth story. I'm selling a story of a business that's gone from being fairly small to now predictably cranking out about 1 gigawatt or more of renewable energy capacity per year. Not an easy feat, I might add. If the sentiment in the market is that that's great that you have the engine, it's great that you have the capability, but there's no capacity on the grid, the value of that investment decreases dramatically. So from my own self-interest perspective, I certainly would want to see this succeed. I think it's important for South Africa, and I think it's fair to say that we need around, on a high voltage side, 14,200 kilometers of line to be built. Eskom reasonably, on average, builds 300 to 400 kilometers a year. This 14,000 kilometers that needs to come online in the next 8 years. We are far, far behind. Now, the new program from the Minister Ramokgopa is exciting and it's important, but it's also in its infancy. We need to see it be realized, and I think there are still some challenges to be figured out. We would have liked to participate in it because we're good at deploying things fast. But the way the rules were written, unfortunately, didn't permit private equity funds like ours to participate. So hopefully we can participate in the future. But to say that this is important is a bit of an understatement. It is absolutely fundamental for the entire industry. It is also fundamental for growing out manufacturing capacity in South Africa and for continuing to deliver to a larger and larger middle class that needs to have cooling in their homes and needs to be able to put the lights on whenever it's needed. So I think we can all agree that the need is there. Now the question is, how do we work together, private sector and Eskom, to make this happen. And I think that's what we're seeing some challenges right now. Eskom is in the fight for their lives. And it is a challenging position to be in if you're them. I would love for Eskom to see themselves as stepping up and becoming the TSO that South Africa really needs. I think Eskom as a generator of power is going to be true for years to come, but less and less so as we see private capital come in and provide the funding that is needed for affordable and clean energy to come online. However, Eskom needs to drive the bus when it comes to transmission and focus on seeing that deployed as fast as possible. And now that we've seen generation stations largely being fixed, and Dan, the CEO of Eskom, have done an incredible job of stabilizing the business. Now we'd love to see NTCSA become fully unbundled. We need the independence in the TSO. That's extremely important. The transmission service operator needs to be independent of the interests of other parts of Eskom that might have very differing views on what should happen. And then adequate resources need to be put through to the NTCSA, both from the South African government, but also from the international community to help make this a reality. So that's my hope, and I'm concerned about this. It keeps me up at night, and I think we haven't seen the last of this topic. The president was extremely clear at the SONA address. It will be an independent TSO. It will own the assets, but one shouldn't underestimate a national utility that has its business model fundamentally challenged by a changing industry and what they're willing to do to defend that. And I think we need to be cognizant of that, and we need to define a way forward for Eskom that respects not only their history, but also the many people that work there.
Thanks, Fred. Certainly more to unpack there, but just moving quickly to you, Karel. What we've seen is that regional connectivity, integration are becoming more and more important, especially in the markets we operate in. It's not only about South Africa generating for itself, but it's becoming more a regional integration model. How do you see the NOAA model expanding beyond just the South African market solution?
Yeah, I think, Rensha, you're right. There are significant demand centers being developed north of the South African border. I think we've spoken about in Zambia and the DRC some significant mineral opportunities, and where I think a lot of energy will be required to be delivered. So I think as a NOAA team, we're trying to answer questions around, do one follow with generation to where the demand centers are, or do you help to try and increase the interconnectivity between the various countries? And the wisdom probably lies somewhere in between. I think for now, provided that the legislation gets put in place, we would love to contribute to the Southern Africa Power Pool from an already well-established generation base. And I think technologies like storage, as an example, I think will help us significantly to unlock the wire infrastructure that exists already. So I think that might be an answer for South Africa, but also I think for the African continent.
Thanks. I got many more questions, but I want to quickly shift to you, Chris. You got investors looking at opportunities. They look at Africa and they say, "There's risk, but we want to go there." How do you balance, return versus risk in terms of your LP requirements and opportunities that may take long? How do you see that play out?
Well, I think I touched on in my initial comments. It's through carefully crafting blended capital structures that allow those investors who are prepared to take a lower return to move nascent markets in higher risk countries to crowd in other commercial investors on top. And that's effectively what we're doing on a very big, broad programmatic basis. So, they are progressive investors that have bought into the moral imperative, because, we're talking about grid and sophisticated South Africa and all those other things, but the elephant in the room is more than 600 million Africans who have no access to electricity. I mean, it's a travesty. With over 100 years of having electricity on the continent, we haven't solved that problem. So I think they have a very purpose-driven intention to fund that, but in a cautious way that we can structure, and then build scale through also country compacts. The importance of those multilateral organizations and the African Development Bank and others of crafting country compacts that can resolve headwinds and regulatory issues that we have with distributed renewable energy. I mean, we're talking last mile here on the energy access side. We've done all of our large grid connected stuff. This is the other side of the equation. And that requires a lot of complex moving parts. But so you've got to build a sophisticated model that can actually solve all of those moving parts. And I think it's a group of progressive investors combined increasingly with global philanthropic organizations and then incoming commercial investors on the top.
And I think you challenge the banks. We take that challenge on. Just the last question. I see my time is up to Wezi. Wezi, the Zambia model, you've got offices now in DRC opening up in Zim, as well as Namibia and South Africa. I mean, how do you see your investor base and your partners accepting that and being part of your growth story? Or do you still see this as mainly focusing on what you've achieved in Zambia, and how do you see the next phase?
Well, Rensha, I think when it comes to infrastructure investment, be it roads, rail, and electricity is no exception. I think we would do ourselves a great disservice if we continue and perpetuate a nationalistic view. And especially when it comes to downstream infrastructure investment, transmission, and related assets. When we take on a regional perspective, and when it comes particularly to integrating renewables in our grids, if we approach that in a smart way with a regional perspective and making those projects bankable, they work when you have regional trade, and then you also attract private financing into those. So it's a very deliberate strategic step on our part to view electricity and supply security. In fact, the very mandate that, at the turn of the century that the SAPO set up for to ensure or enhance, energy security in the region. From a private perspective, we reinforce that and see that as a regional initiative. When we can build, interconnectors that facilitate trade, it stimulates, backward, infrastructure investment within our national borders. Secondly, when that trade, or to trade effectively, or to even to pursue certain projects in the region that are large, some countries have potential for generation capacity that the market simply cannot absorb. Those projects need an outlet and exposure to the entire region. You need to make that trade as frictionless as possible through reliable infrastructure and reliably managed and predictably managed markets. So the regional perspective is an imperative. In fact, I think the SAP and other bodies have conducted studies that show the region saves in the order of tens of billions by taking on a regional perspective in pursuing these infrastructure developments than a national one. So for us, being able to enable and facilitate that trade, both between ourselves and third parties and between sister companies within region through bilateral structures, is absolutely what the region needs, and is absolutely, we believe, the sustainable way forward. And we are supported by institutional investors that actually have been the region's supporting and cooperating partners. DFIs like Infraco, the Danish government through the AfCFTA, the European Union. And so linking the investment dots for us is, exactly the same as linking actually the infrastructure and physical trading dots in the region to make that viable. So it is, I think we think, will be proven, in the long run. The regional perspective and the ability to interconnect risk and opportunity across borders is what's going to be, the long-term, solution to our delivery.
Thanks. My time is up, but I'm going to summarize in a nutshell. I think you've heard it from the investors, you've heard it from the innovators, the solution providers, not only here, but also across the border, and how we need to collaborate. For me, it's all about partnerships and to be able to deliver to our clients and solution across product, across region, with impact. So I thank all of you for joining. This was a graveyard session, but I hope we entertained you to a little bit. Thank you. Thanks to my panel.
Thank you so much, Rensha. Please give our panelists another round of applause as they make their way off of stage. And I must confirm, Rensha, you didn't entertain us a little bit. You left us incredibly well informed and, of course, gaining a lot more perspective and insight into the work that you do with your peers across the continent. So thank you again to all the panelists as well. And the robust honesty that was also required to make sure that we fully understand the lay of the landscape. It's been a packed day, but we're almost there. I do want you to be mindful of the fact that we will have an opportunity just to solicit your feedback regarding the conversations that we've had, the themes that we've been discussing, and of course the outputs that you have been seeking. So at the end of today's session, there will be a QR code which will flash on screen, where we'll afford you an opportunity just to share your reflections in terms of the conversations that we've had so far today. But you've made it thus far, you might as well stick with us through our last vision. As was mentioned earlier, we have been talking about the amazing opportunities across the African continent, various markets which are implementing strategies, policies, and reforms which aim to make their markets more attractive and keep everyone like yourself as key stakeholders keen and intrigued by the market developments there. We commented on gold earlier today. We spoke about West Africa finding favor and growing in terms of optimism, and of course, implementing key reforms. To help us unpack how this has impacted a country that has remained competitive in terms of gold production, implemented several reforms, and most importantly, also seen a turnaround in terms of their currency performance, being the Ghanaian cedi. Please welcome to the front of the stage, Mr. Gurjan Agblegero, who joins us as the Head of Financial Markets at the Bank of Ghana to help us unpack the vision for Ghana as we move ahead. A warm round of applause, please, for Mr. Gurjan.
Thank you, Gogo. My grandfather will be very happy for massacring his name. But it provides a very good opportunity to just teach how to pronounce it. It's 3 syllables, Agblegero. Thank you very much. I bring you greetings from Ghana, specifically from the Governor of the Central Bank of Ghana, Dr. Johnson Esiama. And on behalf of Bank of Ghana, I'm honored to join this investor session. We sincerely appreciate the invitation to share our perspectives and look forward to a constructive and engaging discussion. As you are already aware, global growth in 2025 proved more resilient than expected, and this is supported by easing inflation, real incomes, and strong investment momentum in key sectors. Financing conditions improved significantly, and through Fed policy easing cycles. And for us, from a middle income or emerging market perspective, what that means for us is these developments will reflect in exports, imported inflation, foreign capital inflows, and a strong local currency performances. So back home in Ghana, macroeconomic conditions have strengthened meaningfully. Real GDP growth improved, with economy expanding about 6.1% GDP in 2025, and this was driven largely by services and agriculture. The Bank of Ghana's Composite Index of Economic Activities all confirms sustained momentum across trade, private sector credit, industrial output, and consumption. Our business and consumer confidence have improved, supported by easing inflation, exchange rate stability, and expectations of lower borrowing cost. The external sector recorded a significant and historic performance in 2025, with current account recording a surplus of 9.07 billion at the end of 2025. And this was compared with 1.47 billion surplus same time the previous year. The strong export earnings is mainly coming from gold and cocoa, private sector transfers, and prudent demand management, which have all supported balance of payment surpluses and help in build-up of reserves. And so consequently, the gross international reserves increased to 13.83 billion, which is equivalent to 5.7 months of imports. This development strongly supported exchange rate performance, with the local currency appreciating cumulatively about 40.67% by the end of December 2025. Inflation declined faster than projected, from 23.8% in December 2024 to 5.4% in December 2025, and further down to 3.8% in January 2026. And this is the lowest recorded since the adoption of inflation targeting regime. This disinflation has been broad-based, both from food and from non-food, supported by tight monetary policy, fiscal consolidation, and exchange rate appreciation. Inflation expectations remain well anchored across households, businesses, and financial sector. And our own internal forecast has put the inflation between 2 to 5% by June 2026. As monetary conditions have adjusted, money market and lending rates have declined, and real private sector credit growth has begun to recover, signaling the gradual transmission of monetary easing to the real sector of the economy. Fiscal consolidation has also been very supportive, with a lower deficit, a strong primary surplus, and a significant decline in public debt. The Ministry of Finance remains committed to strong fiscal discipline and pursuit of Ghana's medium to long-term macroeconomic objectives. Liability management efforts continue through the completion of the domestic exchange program and also through the implementation of the medium-term management strategy, MTDS, both aimed at reducing debt distress and smoothing the maturity profile. So telling you so far has been the fact that Ghana is currently witnessing a significant improvement in macro conditions. There's an appropriate monetary policy stance in place. There is an appropriate fiscal monetary policy mix in supporting the disinflation process. There is a significant build-up in reserves, which is supporting exchange rate performance. There's strong growth outcomes, which we are beginning to observe as output gap closes. The credit growth to the private sector is beginning to pick up. Inflation expectations are well anchored, and our own internal forecast suggests that inflation remains very stable in the ensuing years. But I'm sure all these things I've told you, you've already been or might be familiar with this story. The question many people ask, how do we ensure these conditions are sustained or improved? How can we ensure that this time around things are going to be different? just in an attempt to provide some answers, want to assure that the central bank is committed to its price stability mandate. And as Africans, many of you will agree with me that the issue of political commitment, as far as fiscal performance, cannot be overlooked. And Ghana has been in a very unique position this time around with a president which is legacy focused. In terms of the reforms that is being pursued, to accelerate growth and deepen investor participation, Ghana continues to expand public-private partnerships in critical infrastructure and services. And Ghana is turning towards value-added industries, including agro-processing, digital services, and manufacturing. Back in the central bank, you may be aware of the reforms in the forest market, the forest market operations reforms, which we publicly shared in our websites. There are liquidity management operations, which have all been reforms going in that space. We are building resilience through accelerated reserve buildup to sustain gains and for longer-term transformation. There are also reforms in the remittance ecosystem. The government itself is undertaking a flagship program which is called the 24-hour economy. You are aware of tax reforms that are ongoing. The Bank of Ghana, in collaboration with Security and Exchange Commission, is advancing a regulatory framework for virtual assets. And this initiative is expected to promote financial inclusion, lower remittance costs, and position Ghana as a fintech hub within Africa. And additionally, the Bank of Ghana has also established an investor relations office to strengthen engagement with investors and support efforts to lower Ghana's cost of borrowing in line with debt sustainability objectives. And this office sits right within my department, which is the Financial Markets Department of the Central Bank of Ghana. So in conclusion, the Ghana story looks positive and is projected to remain positive in the ensuing year. Prudent monetary policy, complemented by fiscal discipline, has significantly strengthened Ghana's macroeconomic fundamentals and improved its credit outlook. The Bank of Ghana remains fully committed to credibility, transparency, and consistency in its policy actions. And our objective remains clear: to maintain price stability while supporting sustainable economic growth. With these few words, I want to thank you for your attention. Thank you very much.
Thank you, sir, Mr. Agble Zeroru. Getting there. We'll learn. Thank you so much, sir. Appreciate it. And as we've heard, lots of markets are keen, eager, and open for business. Ghana is one such particular market, and we'll continue to hear more as to how it remains competitive within this space. While I do want to highlight that today has certainly been a very strong foundation for the themes that we've been hearing. And most importantly, we've also solidified it with clarity in terms of how we need to best manage our diplomatic partnerships, engagements with our peers in a world that continues to face ongoing volatility behind geopolitics. But today, we're going to tie it all up to make sure that we do get some feedback to fully understand tomorrow when we engage further in discussions that will have a lot more clarity as to how we go by in identifying key partners to work with, opportunities and new innovative solutions that we can explore, and most importantly, understanding how best we drive these ambitions into actionable items. So, ladies and gentlemen, we're going to hear our closing for today, reflecting on the myriad of themes, discussions, and conversations that have been held. A key leader as well who joins us from the CIB Group of Standard Bank, taking care of CIB, Head of Corporate and Investment Banking for Standard Bank South Africa. Joining us is going to give us closing remarks for today, following which you'll have the opportunity to share your feedback through a question and answer session that will be held on a QR code. This is where you can just share your feedback regarding the outcomes, the conversations, and the themes that we have discussed for today. But that will come on the other side of our closing remarks by Mr. Stephen Barnes, the Head of Corporate and Investment Banking South Africa for the Standard Bank Group. A very warm welcome to Stephen Barnes.
Thank you very much. Exactly. His Excellency Ban Ki-moon, Honourable Ministers, Deputy Ministers, Central Bank Governors, Deputy Governors, clients and partners of Standard Bank, distinguished guests, colleagues, ladies and gentlemen. Hopefully that's all protocols observed. Good afternoon. As we conclude the first day of the second annual Africa Markets Conference, I'd like to extend my sincere appreciation to all of you for your participation, your presence, and your meaningful engagement. It's been an incredible day, in fact, an incredible 24 hours, starting with the creative arts session last night, giving us all a perspective on the power of that sector and the material difference it can make to African growth. But equally and importantly, how it's inextricably woven into national identities and value propositions, and how it can drive broader social unity and can encourage critical thinking and innovation. I actually thought it was an incredible start of our time together. The thematic of this conference is connecting global capital in its various forms with development opportunities prevalent on the African continent, particularly in energy and infrastructure. Investment into productive infrastructure and sectors that grease the wheels of the broader economies create that multiplier effect which Trevor Noah alluded to last night, where every dollar that you land up spending has $3 to $4 of incremental value in the broader economy. And when we get that right, at scale, we have the power to really unleash the potential of this incredible continent. That's our ambition at Standard Bank. In this regard, today's sessions and discussions were both insightful and substantive and explored practical and innovative approaches to making this ambition a reality. I'd like to thank all the participants who joined us today for your contributions. Your insights and your expertise are highly valued and much appreciated. And in my opinion, do, amongst other things, help to change the perception of risk on this continent, which is an impediment to capital flows and was referenced as an important objective during the discussions today. On the audience participation section earlier today, I did note that the audience got 75% of the market calls right in 2024, which is actually an exceptional trading outcome. This year, though, only 50% of the calls aligned with our experts, which means that if the experts are correct, which of course is a massive if, you may just as well put your money on red or black at the local roulette table. So Alex and Shola, to keep ourselves properly honest, perhaps you can add to your review next year, not only whether the audience got it right, but equally whether our experts got it right. And then, with that empirical evidence, we could either confidently suggest that our expert will be well placed to assist the audience with their market views and investment strategies, or alternatively that we should be using this audience to formulate the Standard Bank trading and risk management strategy for the year ahead. So thank you to the various country representatives for shining a light on your respective strategies and visions for your countries. Although these are short speed dating type pitches, it's always powerful to hear it directly from yourselves. And I know that you are making yourselves available during the course of the conference to meet bilaterally and in smaller forums with interested investors and other stakeholders to engage further. I'd like to extend special acknowledgement to our distinguished guest, His Excellency Ban Ki-moon, former Secretary General of the United Nations. His contribution was both compelling and thought-provoking, gaining perspectives from an individual at the highest levels of multilateral decision-making and who has translated vision into tangible outcomes was absolutely invaluable. It's clear to me at least that in this increasingly multipolar world with elevated geopolitical risks, that there is perhaps even more need now for organizations like the United Nations to drive shared solutioning, shared rules, and shared responsibility. These outcomes will be critical to ensuring a prosperous outcome for our continent, particularly as we tackle fundamental issues such as climate change, economic prosperity, and global peace and stability. Further, it is clear that Africa has a critical role to play in ensuring a more stable global outcome and in driving sustainable growth in the coming years. But that doing so will take leadership and commitment from all leaders across the continent, including those in both the public and private sector. As we enter the second year of this conference, I'm confident that the AMC gives us an effective platform to align our organization's purpose of driving Africa's growth with the thought leadership, plans, discipline, and execution commitment required to turn that purpose into measurable impact. Thank you once again for your engagement and your participation today, and I look forward to welcoming you back tomorrow as we continue to build on the momentum that we created today. Please enjoy the rest of your evening, and thank you very much.
Ladies and gentlemen, on your way out, please will you scan the QR code and give us some of your feedback. It's an online survey, just 3 quick questions. And for those of you that are not in a rush, please do join us outside for some light canapes and drinks. Thank you for your time, and we'll see you all back tomorrow.